So in this video, I'll be answering some of the really great questions that I've been getting from you guys lately. We're gonna go through a handful of these to see if we can shed some light on the things you want to know the most, starting with this question here from Ben, who asks, if I only have $200 to invest every month, would you advise to continue dividend investing or just dollar cost average in the S&P 500? And that's a really great question. Something like this is actually one of the most common questions I get, and I'm not 100% on this, but my guess is that Ben is asking this because he thinks that $200 per month won't be enough to build a meaningful dividend portfolio. And if that's the case, don't underestimate what that can grow into across a 20 or 30-year time period. Using the MarketBeat.com dividend calculator here, let's actually put together a sample portfolio and see what that might look like after 30 years of investing $200 per month. In our setup here, we'll start completely from scratch at $0, and as you can see, every single year we'll invest $2,400, which breaks down to $200 every month. Now, as far as these stats go, I've input it as if we were just investing in SCHD. So right now, SCHD has about a 3.3% starting dividend yield, and their dividend growth rate is in the double digits right now, but I'm gonna be a bit more conservative and say that across a long period of time, SCHD's dividend growth will only be about 7%, and I'll assume the same number for the share price appreciation. So this starting yield here, this 3.3%, won't change over the years because the dividend growth rate and the share price appreciation are both the same. And once again, we'll look at this across a 30-year time period. Now, looking at the results, after 30 years of investing only $200 per month, you'd end up with about $380,000 in this portfolio, and in that 30th year, you'd be bringing in almost $13,000 per year of dividend income, so over $1,000 a month. And what's crazy is that throughout this time, throughout these 30 years, you'll only have invested $72,000 of your own dollars, which means the rest of that portfolio value will have come from share price appreciation and from dividends. That's definitely not nothing. Still though, if you're not that stoked about having that amount of money after 30 years, maybe you were hoping for more, keep in mind that this was accomplished by only investing $200 per month. Ideally, as time goes on and your income hopefully grows, you should have more money to put into your portfolio, which will make a huge difference over time. For example, let's say you were able to get to a point where instead of only investing $200 per month, you were able to bump this up to $100 per week, which amounts to $5,200 per year. After 30 years of investing $100 per week, your portfolio value would absolutely soar. And after these 30 years, you'd have almost $830,000. And in that 30th year, you'd be bringing in a lot more dividend income. You'd be bringing in close to $28,000. And let's look at this once more. Let's say you were able to double the contributions from here. So instead of $200 per month or $100 per week even, let's say that you were able to do $200 per week, which would be $10,400 per year. From here, things would start to look pretty dang cool. After 30 years, you'd have a portfolio valued at almost $1.7 million, which is insane. And in that 30th year, you would have brought in almost $55,500. Overall though, as it pertains to a more dividend investing type of approach versus just investing in the S&P 500, if you're on the fence between the two, there's no reason why you can't do both in your portfolio. I personally dollar cost average into both SCHD, which is a more dividend focused ETF, and VU, which is an S&P 500 ETF every single week. And I think something like that is just such an easy strategy to stick to. It's completely hands off. Okay, you don't have to think about it, and it gives you the best of both worlds. I think if you're brand new to investing, or if you're just looking for a more hands-off approach in general, a split between a more dividend-focused ETF like SCHD, or VYM, or VIG, or DGRO, or any of the other ones, along with the S&P 500 through VU or some other S&P ETF would be a great way to go. Anyway, guys, moving on to question number 2. This one comes from Ryne, who asks, do you typically have a monthly budget you allocate to investing? Does this ever change when there is a dip and you feel like stocks you've been eyeing are on sale? I feel like I struggle with holding cash, especially during a dip when there are so many stocks I've been watching at attractive prices. I want to constantly be buying. So this is another great question. I don't invest a fixed percentage of my monthly income because my income tends to fluctuate every single month. Instead, what I do is invest a consistent amount every single week that I'm comfortable with and that I know is well within my budget. And my aim is to gradually increase the contributions to my portfolio over time as my income hopefully grows. With that said, I completely understand your struggle with holding cash. I always wish I had more to invest. I think every investor feels that way, and I don't think that's something that ever goes away. And I will say, the fact that you feel that way, I think is a good thing. And I think that can motivate you to work harder at increasing your income so you do have more to invest. And it also gives you a good reason to not recklessly spend your money, because the more money you make and keep, the more you have to invest. This is why I think everyone should be budgeting. If you do that, you could probably find at least one or two things to cut back on that would immediately unlock more money that you would have have to put into your portfolio. And on that note, I want to talk to you about one of my favorite budgeting platforms and the sponsor of today's video, Squad. As investors, we are constantly looking for more money to contribute to our portfolios, and the best way to do so and to see where all of your money is going is through budgeting. Everyone should be budgeting. The problem though is that most budgeting apps these days make you give up your bank login credentials in order to sync your transactions. And while this does make things convenient, giving up this information comes with some pretty serious risks. By providing your bank login credentials to these third-party apps, you're giving them access to some pretty sensitive financial data, including your account number, routing number, full name, address, and you even give them the ability to initiate transfers, which is kind of sketchy. But this isn't the case with Squad. Squad prioritizes your privacy and security and is unlike any other money tracking platform I've used in the sense that it allows you to automatically sync all your transactions without making you give up your bank login credentials. Instead, all you need to do is set up your spending and deposit alerts from your bank or credit card provider to the Squad Scan email address you receive upon signing up. And then from there, Squad instantly converts these alerts into categorized transactions in the app. All in all, guys, it took me maybe 2 minutes to get everything set up, and that includes uploading all of my old transactions, which you can download from your online banking app and send to your Squad email address. It's super easy. With Squad, there's no ads and there's no concerns over the safety of your data because you're not giving them any of your sensitive data, which is the best part. So overall, if you're looking for a better budgeting platform, I highly recommend you check out Squad, which you can actually do for free. Click the link in the description of the video or in the pinned comment to get a free 15-day trial. And if you like it, their Duo plan is only $11 per year, which is an absolute steal. Not only that, but you can also take 15% off of the already extremely generous subscription price by using code Ryne15 when you check out. I've personally really enjoyed using Squad, and I think you will too, so definitely check out that free 15-day trial in the description or in the pinned comment and join the Squad today. Anyway, getting back to it, guys, this third question here comes from Mark Rauch, who asks, can you quickly explain the relationship between the payout ratio and the growth rate along with the yield? I'm a bit confused when it comes to how all these things lend a hand to each other. Absolutely. So let's go through all of the basic dividend stats that you'll definitely want to get familiar with. And let's start with the payout ratio. The payout ratio is the percentage of a company's earnings it pays out in dividends. And you can calculate the payout ratio by dividing a company's dividend payment per share by its earnings per share. So for example, if we look at Coca-Cola here, the dividend payment per share is $1.94 and the earnings per share is $2.82. So if you run the numbers, the payout ratio would be about 68.8%. Now moving on to the dividend yield, this can be found by dividing the dividend payment per share by the current share price. And looking at Coca-Cola once again, the current share price is $63.03. So 194 into 63.03 puts you at a 3.08% dividend yield. And with that said, many dividend paying companies have a tendency to increase their dividends every year. At least those are the kinds that you want to own. As we can see here, Coca-Cola has increased their dividend payments annually for the last 61 straight years, which is absolutely insane. And then on that note, the last metric that you'll want to know is the dividend growth rate, or we also call it the CAGR. But this is the compound annual rate that the company increases its dividend by. So for example, Coca-Cola has a 5-year growth rate of 3.5%, which means that the company has increased the dividend payments by that amount on average every year for the last 5 years. But anyway, guys, now moving on to the fourth question here, which comes from Shannon. This one came in my email inbox. As you can see, it's a bit longer, but Shannon says, I wanted to ask your thoughts on how to justify investing in highly valued stocks like Home Depot or Lowe's. I have a hard time pulling the trigger due to the amount of dividends paid versus Coca-Cola. It just seems that the amount of shares you can own and compounding would be greater with Coca-Cola. Here's my example by the numbers, and here you can see he presents an example where you have $1,000 invested into both Coca-Cola and Home Depot, and with that $1,000 invested, you would generate about $31 in dividends per year from Coca-Cola, and with Home Depot, it would be about $26, so $5 less. And Shannon says, I just have a hard time with his type of logic. Essentially, why would you invest in Home Depot when Coca-Cola pays you more dividend income? What are your thoughts? So because Coca-Cola has a higher starting dividend yield, you will generate more dividends with Coca-Cola right off the bat. That's true, but I think you're fixating too much on the income amount starting out, and you're not taking dividend growth or the dividend growth rates into consideration, which will make a substantial difference over the long run. If we compare the dividend growth rates of these two companies, we can see that Home Depot is raising their dividends at a much faster rate than Coca-Cola, which means that over time your yield on cost and the amount of income you're generating from Home Depot will likely surpass the income you're generating from Coca-Cola. And we can actually see what this looks like. If we were to go back in time, back to 2014, and invest $1,000 into both of these stocks, $1,000 in Coca-Cola, $1,000 in Home Depot, and then invest like like $100 per month into each of them from there until today, first and foremost, we can see that you would have ended up with a considerable amount more money investing in Home Depot in this time than Coca-Cola, to the tune of about $7,000 or so. And if we look at the dividend income, we can see that the same is true here. I mean, starting out, going back all the way to 2014 or 2015, sure, in that first year, or rather in those first few years, you would have had more dividend income coming in from Coca-Cola, but there would have been a point here a few years in where the Home Depot dividend income would have surpassed Coca-Cola. And I think in this year, Home Depot raised their dividend by something like 32%, which is why we see this crazy jump here. And then from there on out, the spread between the Home Depot income and the Coca-Cola income would continue to grow. Also, at the end of those 10 years, the difference in yield on cost would be pretty substantial. You'd be generating a much higher cash flow return with Home Depot than you would with Coca-Cola. And the spread between the two here only occurs because Home Depot has a much higher dividend growth rate. With that said, though, that doesn't make Coca-Cola a bad investment by any means. Coca-Cola is one of the most steady, dependable dividend payers out there. Overall, I think it's good to have a balance of different types of dividend stocks in your portfolio. I think it's great to have some more of these stalwart, sleep well at night stocks like the Coca-Colas. I think it's good to have some more dividend growth stocks like the Home Depots. And I'm even a fan of having some high yielders in there. This is what I like to do in my portfolio. And if you want to see my full portfolio, you can check it out in this next video right over here. In this one, I'm showing you every single holding in my portfolio, including the number of shares, as well as the gain and loss for each position. So click right over here to check all that out, and I'll see you in the next one.